All right, thank you, everyone. Said too loud. Just make this a bit lower. All right, so we'll go over trouble-free financial reporting, just going over some common financial reporting mistakes, and then what you could do to uh, avoid them or mitigate them. So we'll go over the different components of the financial report and what types of errors occur in each part. Uh, so what are the most common types of reporting errors, plus a few others, best practices. So I'll load these slides all at once. So the introductory section of the ACFR includes your transmittal letter, your org chart, your listing of principal officials. Does that sound fine? Sounds a bit crispy, okay. Bit higher. Okay, thanks. The financial section includes our independent auditors report. There are some errors, unfortunately, that do happen in this as well. So I just have a couple things to point out. Not your responsibility, of course, but we always appreciate if you do catch something. We're not going to take offense to it. The basic financial statements, the notes, the required supplementary information, and then the supplementary information, and the statistical section, which includes variety of statistical information, such as financial trends, revenue trends, debt information, demographic and economic information, and then operating information. So I know GASB can be quite complicated and can inspire us all. So I just wanted to mention that one of our clients made even a song about GASB using AI. It's quite funny. But anyway, so this common errors that occur throughout the report. So just the labeling of information. So net pension obligation and net other post-employment benefit obligations, those are outdated terminologies. Now it's referred to as the net pension liability and the net other post-employment benefit liability. Net assets. There is one exception on when you should be using net assets, and that's in the description of deferred inflows and deferred outflows in your disclosures. Net position includes deferred outflows and deferred inflows. So you wouldn't include net position in the description of deferred outflows and deferred inflows. It's a bit annoying because they made us change it to net position, and then later on they gave us a comment again to change it back. So anyway, invested in capital assets, net related debt. Now you refer to it as net investment in capital assets or investment in capital assets. Fixed assets should now be capital assets. Agency funds, and then just not the appropriate use of expenditure or expenses. Expenditures refers to governmental funds, which would include your capital outlay and debt service payments. Expenses are used for your proprietary funds and your government-wide statements. And another common theme is your amounts from different parts of your report not agreeing to other parts of the report. This is not uncommon when you have last-minute changes. You then need to have someone proof the report again from the MD&A to transmittal letter to the notes to statistical information, just to make sure everything is still consistent. Okay, just looking at the transmittal letter, common theme is the incorrect date. So the date of the transmittal letter can be after or the same as the report, the opinion date, as we refer to it. It can't be before. So this might happen if there's a delay, maybe a last-minute adjustment. The opinion gets dated slightly later than what it was anticipated as. You also need to go and change the date of the transmittal letter. Redundant information, missing statement regarding internal controls. So there is standard verbiage that you would include in your transmittal letter that discusses the limitations of internal controls. Budget information, identifying funds with legally adopted budgets, what's the level of budgetary control, and then a summary of the budget process. And now with tax abatement disclosures, you also need to have a discussion regarding the expected long-term benefits of having those tax abatements. This is just in the transmittal letter. In terms of our auditor's report, so common error is the paragraph that discusses the supplementary information, which would be your combining schedules, your non-major budgetary schedules, and any other supplementary information you may have in there, maybe something to demonstrate compliance with a tax measure or debt covenant. Those supplementary information has to be included in this paragraph that discusses the scope of the supplementary information and on also what's our opinion on the supplementary information. Again, this is not your responsibility. It's ours to make sure everything is correct, but it's just something that's been identified as a common error. MD&A, I know Ahmed already covered the MD&A and kind of critiqued it a lot, but some of this information that's the common, I guess, complaint is the discussion. So I'm not going to, I guess, restate what Ahmed has mentioned, so I'll just skip that. But yeah, I'll just skip this because I think everybody knows. But there is this nice graphic from Michelle Mark Levine from the GFOA that kind of helps you in terms of, what do you want to write about? And kind of the advice is to disaggregate the information. So when you're looking at change of net position, so I'm just getting last. You want to break that down into looking at your revenues and also looking at your expenses. Within revenues, you have tax revenues, you have grant revenues, you have contributions. So you can analyze what happened to those separately. And then after that, kind of then come up with the why for each. Obviously, if you're just looking at revenues and it includes a whole variety of things to come up with the why, I don't know, could be this, that, how do you write that down? Obviously, you don't write about every single thing. Obviously, you want to maybe identify what's material. That's the material contributing criteria there. So just something to think about. Other tips, this was from something I read before, is that, keep a folder, call that folder MD&A. Obviously, it doesn't have to be a hard copy folder now. You can have a folder in your desktop. Anything that happens that's significant during the year, maybe council passed a significant resolution, you have staff reports that you report to council or to your board, just save those in that folder just throughout the year. That way you don't have to look for information at the end of the year when you need to draft your MD&A. You open up that folder, it has all that information that's relevant to what occurred, and then it gives you, just some memory joggers of what you want to write about. Okay. You need to direct readers to the notes. That's not occurring all the time. These are where you need to refer to the notes. You don't need to rewrite the note, just mention that, see note for this on page. The page number is not necessary, but helps. Looking at the financial statements, so common issue here is the transfers not netting to zero. So in your general ledger, you may have a lot of accounts that are called transfers, but really on the financial statements, they don't always go in the transfers line item, like interfund cost reimbursements, interfund allocations, maybe transfers to agency, I guess no longer agency funds, custodial funds or your trust funds. So you may have them in the GL labeled as transfers, but on the financial statements, they don't get presented there. So if you're not careful where you're actually classifying those items, you'll end up with the transfers not balancing. And that's, that's going to be a problem. Your tax revenues versus intergovernmental aid. So tax revenues are revenues that you've, I guess you're the source, or you're putting on the, like your property taxes, sales tax. Those are your revenues versus you may have a county-wide measure for transportation sales tax, like your Measure B here in Alameda County. That's considered to be not your own source. So that would be considered to be intergovernmental aid or shared revenue. There is a white paper. I mean, it's quite outdated. Maybe needs to be refreshed. Just looking at a variety of different California revenues and then what's the appropriate classification of those revenues on your government-wide statements, whether those are operating, capital, general revenues, or program revenues. Um, Probably could use an update, but I still use it from time to time. Your net investment in capital assets calculation. So this is quite something that the GFOA is kind of, I guess, enforcing a lot more now. They've even came up with their own template, which is helpful. I would recommend using that template in calculating this net investment capital assets amount every year. Incorrect reporting unit amounts used. You may be using your enterprise funds amounts and not capturing the correct enterprise amount of debt for a different amount of capital assets. I mean, I find it hard to imagine how that would happen. So it hasn't happened to me personally, but that's something that the GFO has pointed out as occurring frequently. Unspent debt proceeds. So if you recently issued a debt near the end of the year, you may still have a large amount of that those debt proceeds that are not spent yet on capital projects, which would be in your trust restricted cash. So it's not appropriate to include that portion of debt as a net against your capital assets because you haven't built any capital assets yet. So you're meant to reduce those debt amounts or not use those debt proceeds in calculating your net investment capital assets. Other capital related liabilities. So you may have retainage payables, or you may have capital related AP that haven't been used yet. They still are considered to be debt. So you should be including your capital asset calculation. Your deferred gain or loss on refunding. So if you refunded a capital debt, you may have a deferred gain or loss on accounting. That should be included in the calculation. And again, you want to utilize that worksheet. These are things that you don't want to include in the calculation. So any bond issuance costs, those shouldn't be included in your calculation. Deferred outflows or inflows associated with non-capital debt. So you may have your pension bonds that you've issued that may have been refunded. And so you have a deferred gain or loss relating to a pension bond. Then you have another debt, which is a capital debt that was also refunded. So you have a deferred outflow for that as well. You want to exclude the amount that's relating to the non-capital debt. Internal borrowings, so you may have interfund advances, those shouldn't be included. And also equity and interest in joint ventures. So you may have a sewer facility that you've jointly constructed with another agency. You report an equity interest in joint venture there. That shouldn't be included in this calculation. All right. I think this is quite common. I mean, I don't think we've enforced it that seriously, is the restricted net position on the government-wide statements. Usually you do want to have something that's a bit more detailed in there. If you just have one line item called restricted net position, you do need to have disclosure to break down that restricted net position to different categories. Some agencies generally just have restricted for cap projects, restricted for pension, restricted for debt service, restricted for special purposes, and then the special purposes is quite large. So that's what they want to see more detail, or if it's too much detail to put on the face of the financial statements, then you may just want to have the disclosure instead. Okay. So long-term liabilities include pension and OPEB liabilities. Hence, they should also have a current portion. So if you report your government-wide financial statements using the classified format, you should be reporting a current portion in certain situations. So the first one is probably unlikely. So that's when you have a funded plan. So you have a trust for those liabilities, and the current portion of the debt or the liability exceeds the amount that plan is funded by. So this may be when you have very minimal funding in the plan. So if you have like $5,000, for example, why would you have only $5,000? But say you have $5,000 in the trust and your current portion is $100,000, you would report a current portion of that $95,000 excess of that trust amount. And then unfunded plans, like a lot of clients have OPEB as completely unfunded. So you just have a total OPEB liability. The amount that you expect to pay next year should be reported as the current portion. And now you'll also need to consider your GASB 87 and GASB 96 liabilities as well. Right. Again, classification of revenues. Regarding your capital program revenues, so on your statement of activities, you have capital revenue, that's program revenue that's reported in your enterprise funds. So it has to be consistent. If you're reporting in your water fund, you have capital contributions, then it's expected that when you go to the statement of activities, you're going to have capital contribution there as well. You can't have it mapped to operating here and then capital the other way or vice versa. And that's sometimes when you may have a grant and you have a line item that, depending on what that grant revenue is it for capital, not capital, and you have to look at it every year. That's probably what's happening there. Unavailable revenue, unearned revenues. So on the government-wide financial statements, you shouldn't have unavailable revenue. Unavailable revenue is a term or is something that relates to only governmental funds. And it's not a liability, it's a deferred inflow of resources. Regardless, it shouldn't be on the statement. Unearned revenues is a liability. So if you have unearned revenues on your governmental funds, that unearned revenue should also be on your government-wide statements. And I think that just comes from previously, it used to be all combined and called deferred revenues. And you haven't really made that effort to change, use different accounts. So you're still using those deferred revenue accounts in your general ledger, and you have to then break it out or change where you want to put it every year. It's easier if you just have two accounts now. I think they're not going back. So hopefully we'll see. They keep making changes. And then no deferred gain or loss on refunding reported. So you've issued you've refunded an old debt. You're meant to be calculating what's that accounting gain or loss on refunding. You're not just supposed to kind of run it through expense and it goes away. Maybe if it's immaterial, we'll think about it, but that's not really what's supposed to happen. And then this is the big one that's with the fund financials is, you're missing a major fund. And this is something I caught a couple of times. Is just that the numbers change during the audit. And initially, maybe something wasn't a major fund. And then all of a sudden now there's a big adjustment that you made, especially I think with ARPA funds where everyone maybe have recognized it immediately as revenue. And then you're like, no, it's based on how you've spent it, how much have you spent. And then that went into deferred inflows, which is usually liabilities, and deferred inflows, usually the smaller part of most funds. So then that becomes over 10%, and now it's became a major fund. So really you want to recalculate that every year. You want to recalculate it again before you finalize the report. And when you recalculate it again at the final draft, you want to use the financial statement numbers, because sometimes you may have in your trial balance, the way you've set it up, the accounts may not be going in the correct spots. So essentially, or sometimes you may have the preparer who's doing above ground type of adjustments. So they're manually adjusting at the top without really adjusting the general ledger. Maybe you have negative cash and you want to reclassify it to due from. So you just on the financial statement say, plus in the Excel file, just plus $10,000 here. However, that then changes the math because it's all based on the total assets, total deferred liabilities, and so forth. So you want to use financial statement numbers when you do this. There's no option to exclude funds that meet the criteria. So if you want to include a fund as a major fund that didn't meet the criteria, you can include it. However, there's no option to do the reverse. There's not a situational ship thing where, well, this has never been a major fund and next year it's not going to be a major fund. So can we just not keep it as a major fund? You have to put it as a major fund. And then, as I mentioned, there's no materiality concerns here. 10.01% is still over 10%. you know, if you want to change, if you want to make adjustments, I mean, obviously that's not appropriate either, but if the math adds up this way, then you're going to get a comment for it. And also don't forget deferred inflows and outflows as part of the calculation. All right. So non-spendable fund balance. So non-fund, this would normally include items like long-term receivables and inter-fund advances. However, if those repayments are restricted to be used for a certain purpose, so you may have those low-income program first-time home buyer loans that are outstanding. Those are restricted. You have to then, when someone repays those loans, you have to then reuse it to use it for that specific purpose to reloan it out. So that would be restricted fund balance. It wouldn't be considered to be non-spendable fund balance. It is still in nature non-spendable. However, the proceeds are restricted. So you would then have to classify it as restricted, or if it's committed or assigned. So if you have a different situation where council or the board have committed those repayments to be used for specific purposes, then you would still report it as committed or assigned and not non-spendable. Okay. Just a lot of disclosure issues regarding stabilization arrangements. Negative assigned fund balance. So you cannot report negative assigned fund balance. Assigned fund balance assumes that there is fund balance to be assigned. So if you have no fund balance to assign, you can't have negative assigned fund balance. You would have to reclass it to unassigned. So it can never be a situation where you have negative assigned fund balance. You may, in a confusing area, is you may have a situation where you have, let me think about that again, but I was thinking about restricted fund balance. You may have situations where you may have both restricted fund balance and negative unassigned when there are multiple revenue sources that flow into a fund, but I'll probably skip that for now. And then you can't have positive unassigned fund balance in any other fund except for the general fund. Just the fact that you have a separate fund for this revenue that you're reporting makes it at least assigned. You can't necessarily say that, well, we have some money left over here in the capital project fund and it's unassigned, because it's a capital project fund. It's assumed that it's assigned for some kind of capital project. Otherwise, why is it there? So only the general fund can have positive unassigned fund balance. Okay. I'll just go through these. So other financing sources and uses. So similar to, as Ahmed mentioned, for GASB 103 and non-operating revenues and expenses, this is very specific as to what can be included in here. If it's not listed as to what can be included in this category, then it's meant to be reported elsewhere. So that's where you need to think about whether it should be there or not. Language of issuance of debt should be used, not proceeds from debt, which I also have a bad habit of saying proceeds from, because I think you have proceeds from the sale of capital assets. So you usually default to proceeds from debt, but it's supposed to be the issuance of debt. Having a different line for premiums and discounts should be used. Similarly for issuance of refunding debt, and then also for the payment to escrow when you're defeasing a debt. And all these items would have relating disclosures. So these items should agree with those disclosures. Special revenue funds. So it's always funny with, I think it doesn't happen as frequently anymore, but special revenue funds, I think in the past, you'd question, why is this a special revenue fund? And he will mention, well, I think this revenue is special, so I'm going to actually report in a special revenue fund. However, it's actually more relating to the expenditures of that fund, and if those revenues are restricted for that specific purpose. So if the revenues don't really have any restriction as to how those revenues should be used, then it really should be rolled back into the general fund. There is some differences. If you have a budget, in the budget, it's budgeted as special revenue fund. For financial reporting purposes, it has to be rolled into the general fund. Then you're required to have combining schedules to show you the breakdown of that general fund between the general fund and then other funds that are rolling up into the general fund. However, that's something that you may want to look through if you have too many special revenue funds. You need to disclose the purpose and then also what is that revenue source that's restricted or committed. Okay. This is just some regarding the budgetary reporting. So I guess it'll go away with GASB 103, but uh, at the moment you can include it with your basic financial statements or in RSI. You're meant to include your general fund and major special revenue funds. It wouldn't include any major capital project funds or major debt service funds. So it's only the major special revenue funds that you would include here. Your major capital project funds and your major debt service funds, if you're doing an ACFR, that would go into your supplementary information. At minimum, it needs to be done at the functional level, same like the financial statements. If you do have if you're not showing your budgetary schedule at the level of compliance needed, then you would need to include a supplementary schedule that shows you that level of compliance. So you may have, if you're, for example, your financial statements say expenditures for public safety, and public safety includes police and fire department, for example. But the budgetary level of control is at the department level. So the police department have their own budget, and if they would be in compliance with their budget, you shouldn't be netting the fire department with the police department. Then you would need to have a supplementary schedule that would then break down those different functions into each department and show that level of detail to demonstrate compliance. You don't need to do it in the RSI. However, if you do have a separate report, you can refer to that separate report that demonstrates that compliance issue. This is something that they're trying to enforce more last year. I'm not sure if this year's any different, but as mentioned here, you may issue a separate budget report and then just refer to that. I think when you're submitting your ACFR to the GFOA, they ask these questions anyway. Regarding the proprietary funds, so I guess it's something similar or something that GASB 103 will clean up. That is, if it's not investing capital or non-capital, then it's operating. Do not net transactions, missing non-cash activities. So if you have a refunding of debt, if you get into a contract for SPIDA, or if you get into a lease contract for new equipment, there's no cash exchanging at that point of that transaction. However, you are recognizing assets and liabilities on your statement of net position. Those are considered to be non-cash transactions, and those should be disclosed at the bottom of your statement of cash flows as a separate section of non-cash items. Okay. So missing governmental debts. So this happens quite often. So I think it happens now if you issued pension bonds to prepay your unfunded liability, and you're trying to allocate those pension bonds to your different reporting units because portion belongs to your water fund, portion belongs to your sewer fund. They should be contributing to the repayment of those bonds, because otherwise they would have been paying your additional contributions to CalPERS. So you're not permitted necessarily, it's inappropriate to just be recording transfers, say from the water fund and sewer fund to a debt service fund, and then the debt service fund is making 100% of the payments for the pension bonds. You're really understating that liability that you want that to show on those water and the sewer funds. So a proportion of that debt should be reported in those funds. And then when you're repaying those debts, you'll just be reducing the liability. Oops, wrong button. Capital contributions classifications, I think we discussed that already with the government-wide financial statements. Let's make sure I'm doing fine. Okay. All right. Internal service funds, and I don't think it's here today, but I got questioned about, what would happen if you don't comply with this internal service fund requirements. But we see this quite often, internal service funds that have quite large deficits. And sometimes it's because now you're reporting pension and OPEB liabilities in those funds. or they're risk management funds, so they have your claims payable, so they're always going to be in some kind of deficit at this point. Um, but they can be hiding an issue, because if they're continuously growing and those deficits are growing, that just means that not enough charges are being given to those departments that are supposed to be paying for those expenses that you're recording in that internal service fund. So it's really meant to be breaking even, and the amount you're charging should be kind of what your expenses are. Obviously, there's a deficit at this point because it's a long-term liability. However, that deficit is growing significantly. It's problematic. And those deficits, especially with a lot of our, I don't know how many we have anymore, but the cities we've worked with in the past that had financial problems, going concerns, they have had issues with their internal service funds, or kind of buried problems where the general fund looks great. If you're just looking at the general fund, it has plenty of money, what's the big deal? But when you look at the internal service funds, it has like, it has a receivable, not necessarily receivable, it has a large due, how do you say this? It has a due from other funds in there, large due from other funds, or has a deficit. Like, where is it going to get money to pay back its loans? It's going to get the money from the general fund. So it's like the general fund has a receivable from the internal service fund. So what's going to happen? The general fund is going to contribute more money to the internal service funds to repay the general fund back. And so it's like, well, it's not really, it is problematic. So that's something to keep in mind. I think covered this slide essentially, but just want to see something if I want to mention anything here. But yeah, I think the opposite I'll add is that the opposite is also problematic. So if you have an internal service funds that has a fund balance that keeps growing and growing and growing and growing and growing, and it's like, it's a vehicle or an equipment replacement fund, and every year it's growing 20%. It's like, well, when is it eventually going to go and replace those equipment? Even after it replaces the vehicles and equipment, it still has a growing fund balance. And you're like, well, really overcharging those departments and, keeping the general fund a bit dry. So it's something you have to keep evaluating those charges that you're making to those funds. Moving on to fiduciary funds, looking at the investments line item, you should have investment expense that should be shown as its own separate line item as part of the additions. You should have income regardless of if it's negative. Is it really fiduciary? So keep in mind that you want to look at whether you have control over those assets that you're holding. Are you really holding them? Do you have really control over them? Is it really being held by a third party? I think with pension and OPEB trust, this becomes a bit confusing sometimes with PARs. I think there is a white paper that was issued by the Cal CPA, the Government Accounting and Auditing Committee, that kind of clarified or tried to clarify a lot of those things. So I think that's cleaned up a lot. Is it accounting for funds that eventually you're going to be using for a governmental activity? So this is previously you would have agency funds, and you're putting money in there for deposits that you're holding for other people. So it's like, well, it's not my money, so it's fiduciary. It's like, what are those deposits for? It's like, oh, those deposits are for a construction project that we're doing for the city. So it's like, well, that is a city liability. Then it's not necessarily a fiduciary activity that you're holding. So it's not necessarily just that because you're holding it for a third party that makes it fiduciary. You also have to look at, is that liability relating to something that's relating to city activities? A true fiduciary activity is something completely separate, where you have nothing to do with that activity. You're just holding money for a third party and doing accounting or running expenses for them, or acting as a pass-through. Custodial funds. So, custodial fund is not the same as an agency fund. The custodial funds are different. They would have fiduciary net position. So something that has been noticed is, I think a lot of agencies just converted the titling of funds that they had as agency funds to custodial funds. But then you look at the fund and the assets equal the liabilities, and there's no there's no fiduciary net position, and you question, well, what is this liability for? It's like, well, it's not our money. We're, just using it for this third party, whatever they want to expend it on. So, well, that portion that you're holding for the third party is their fiduciary net position. So it can be a bit confusing. Obviously, it's in the fiduciary fund. It's in a custodial fund. So obviously, it's understood that uh, it's not your funds or the city's funds. It belongs to third parties. So you have to really record liabilities that are items that are payable to someone other than the the person you're holding the money for. Also the disclosures. So disclosures still refer to agency funds sometimes. You just want to make sure you clean that up. You need to mention that they use the economic resource measurement focus. Market value, fair market value, those are no longer used. You would use fair value. And some people ask me, what's the difference? It's the same thing. It's like not necessarily. For some things, there is no market. So how do you measure those things that don't have a market? So that's the concept of fair value, where it gives you different methodologies in how you come up with a value of some instrument or item you're reporting on your financial statements. Donated capital assets are reported at acquisition value. So previous terminology was estimated fair market value. You just change that to acquisition value. Missing reference to component unit financial statements, or stating that separate financial statements are not issued for those component units. Investment disclosures, so ratings, missing ratings information. Leveling disclosure is missing. For your leveling disclosure, you also need to describe the valuation technique that's being used. This is something that if you use a pricing service, or your custodian is using a pricing service, they probably have details back in their offices about how they're coming up with those fair values, especially for items that don't have a market. It's like, well, how did you come up with this? I get it in the statement, there's cost, and then you have a column here for your market value, but what is that market value? How did you come up with that for this CD that we've been holding for 2 years? How do you know that's 10% lower, 5% higher? So they have techniques. They look at similar instruments, and so there is verbiage there that should be added. I think that got redundant. Sorry. Disclose when which governmental funds have been used to liquidate liabilities. So generally, you'd be just saying that the general fund. If you use other funds as well, you describe those, and that would be needed as well for pension and OPEB. Compensated absences, as I mentioned, it goes away with GASB 101. Unless you want to still mention it, you're not going to be penalized for that. And then also debt refundings required disclosures. So in addition to mentioning that those are debt refunding, you have to disclose what's the aggregate difference in debt service between your old debt, the remaining debt service of your old debt, and the debt service requirements of the new debt. And then you'd have to also disclose the economic gain or loss. The economic gain or loss is different from your accounting gain or loss that you've calculated to kind of swap out the numbers on your statement of net position. The economic gain, not sure why there would be loss, but you think that you'll only be refunding when there's a gain to it. But usually your financial advisor would be doing a calculation of the net present value savings of issuing the new debt versus having the old debt. That's the number that you'll be disclosing. Okay. Just more long-term liability information. So the purpose of each debt issuance is recommended to be included. You're not supposed to be reporting the deferred loss or gain on refunding as part of your long-term debt disclosure. The table, meaning before, the deferred gain or loss used to be netted with the debt. So you would have a separate line item in your roll forward schedule that shows the deferred gain or loss. Now it's reported as a deferred inflow or outflow. So it's no longer meant to be there anymore. For revenue bonds, you want to mention what is the specific revenue that's being pledged. So if you issued water bonds, sewer bonds, what are those? The revenues that we are repaying those debts. the general purpose for the debt and the term of the commitment, the proportion of pledged revenues compared to the total revenues. So if it's 100% of the revenues or it's 20%, usually I only see it as 100%. And then a comparison of the pledged revenues compared to the principal and interest payments that you made during the year. So your revenues were 120% of the principal interest payment. They were 90%, not just for your debt covenant compliance requirements, but also just it's a GASB disclosure requirement as well. Okay. And then segment disclosures, those are meant to be based on the revenue source, not necessarily the line of business. So not necessarily, in most situations, they may be the same, but not always. Right. Got 5 minutes to lunch. All right, we can go through these a bit quicker. All right, so I think this is more commenting similar to the statement of net position on the government-wide financial statements. When on the fund financial statements, there's just not a lot of good descriptions as to what things are restricted for or assigned for. They're quite generic in descriptions. So GASB is looking for something more specific. So instead of just saying this is restricted for public safety, like this is restricted for fire equipment replacement, or that's meant to be. Significant encumbrances are missing from the disclosures. So if, for example, say you're a fire district and you have, say, $1 million of unassigned fund balance, and then you just ordered a fire truck, and the fire truck costs $700,000 or $1 million probably by this point. So it's good information for the reader to know, because when they see your financial statements, they'll see, oh, they have $1 million of unassigned fund balance, but they don't know that, well, actually, there's going to be, actually, that's probably a bad example, but sorry. But you get the point. That's the significance of the disclosures, to mention so the reader knows how much of that fund balance is going away right after the end of the year. Interfund transactions, you mentioned the intent and purpose. Reimbursements are not transfers. So it's a bit tricky area. It's probably something that can be cleaned up a lot, and there's a lot of confusion. But when one fund is paying for another fund, and then that fund that was meant to make that purchase is just reimbursing that fund that made the expenditure, you're really just supposed to net the two, and then the fund that's doing the reimbursement would report the expenditure. The fund that initially made the payment would not report anything at all, because it just pretend as if the fund that was meant to make the payment made the payment. So those are not supposed to be shown as transfers. Right. Capital assets. So in summary here, things that they've noticed is, say you have equipment for $1 million, and then you have accumulated depreciation for equipment, but now the accumulated depreciation is $1.5 million. At most, it should be $1 million. So these are the things that they're noticing. Similarly, when you dispose of an asset, you're showing a deletion of, say you dispose of an asset that had a cost of $100,000, but the deletion is showing up as $150,000. Obviously, there's some kind of adjustments or corrections that you're doing, but it's just not showing correctly on the face of the financial statements. Okay. Just going for pension and OPEB here. So I think here, so one thing I wanted to mention is there is some requirements to show the aggregate. So especially when you have multiple pension plans or multiple OPEB plans, you are meant to show what is the accumulative pension expense or OPEB expense of all the plans in total. So you may have different disclosures that disclose it separately, but you're meant to also disclose the total. However, you're not required to disclose the total net pension liabilities or the total OPEB liabilities of aggregation. However, we recommend having a table where it just kind of summarizes the amounts for each plan, and then a total. It's quite easy. It helps the review as well when you're trying to tie out the numbers. The column on the right here is talking about the disclosure requirements are different based on the type of the plan, whether it's funded, not funded, whether it's an agent plan, whether it's a cost sharing plan, whether it's a single employer plan. So you can't necessarily go to, you're coming up trying to draft a disclosure. You can't take a drafted disclosure from another agency and say, well, you have to compare all the different elements to make sure it's actually going to capture all your information you need. Or probably best practice is just to go to the guidance and find the template of the disclosure. So you can't necessarily copy everything verbatim. So that's what, in summary, that's what that's saying. Missing information. So these are disclosures that are required, but aren't always disclosed. And it's a bit of the same issue with the previous slide where because you're using the wrong disclosure template, perhaps. So now you're missing information from what you're supposed to be disclosing. So these are common things that have been missing: the type of the plan, the schedule of changes, details on the deferred amounts, how to obtain information from the plan, or from the financial statements from the plan, assumption information, sensitivity disclosures. Uh, so there's some terminology here for the required supplementary information regarding pension. There's payroll and there's covered employee payroll. In simplicity, covered payroll assumes that there's a relationship between employee earnings or the participant earnings and the contribution you need to make. So covered payroll would be used for your CalPERS disclosures. But you wouldn't necessarily use it for your OPEB disclosures. If OPEB, you're not, if an employee earned more, doesn't mean that you have to also contribute more to your OPEB plan, unless you've kind of stated it that way. So covered payroll is going to be used for in those situations. This is a table here. I won't go through everything, but that's the situations you'd use it. If you have a non-trusted plan, then you're always using covered employee payroll because you're not required to make any contributions to the plan. Or you're not making contributions at all. This is no trust. Got it. All right, I guess another issue is the measurement period. Like what you have, if you have a lag between your measurement date and your report date, then which payroll you want to report? Do you want to report the one that's relating to the measurement period, or you want to report the payroll relating to the reporting period? So some schedules show information that relate to the reporting period, like such as your contributions compared to your actually required or contractually required contributions. Those would be, you'd report the payroll relating to that reporting period. Things that show information regarding the net pension liability or the net OPEB liability that has information as of the measurement date, then that should be reported based on the measurement period. So that's just one, you have to kind of look at the schedule and just see what is it reporting and then show the correct amount of, or the relating amount of payroll relating to that. When you have your schedule of contributions and it's based on actuarial information, you have to disclose the actuarial assumptions that were used to derive the contribution amount. So this is often confusing because not sure why, but CalPERS, when they issue their agent multi-employer plan GASB 68 information, they have their schedule of contributions, and underneath that schedule, they have the actuarial assumptions that went into that required contribution. It's often, it's not often that I hear from clients and I'm recommending them edits to their financial statements and the disclosures that they use the wrong disclosure information, and they come back to me and say, well, the GASB 68 report shows me this. It's like, no, that's not they actually have a separate supplement that shows you the actuarial assumptions that go into measuring the liability, but the one that comes that you download off my CalPERS, that has this actuarial assumption information, which because there's also another lag for this, the actuarial assumptions are not always the same between the ones used to measure the liability and the ones being used to determine how much do you need to contribute to the plan. Okay, I think this will be actually, sorry. I think this, for at least for GASB 68, now we're on the 10th year, so now we should have 10 years of information. Before, because we were not reporting 10 years of information, we would have to disclose, there's not 10 years of information required. Um, but you would have to, I guess an issue they found is that, sometimes it's not always presenting the correct amount of years of information. And especially, I guess, with GASB 68, since we were adding a column every year up till we're getting to 10, if you just copy what it was last year, someone may have just thought that they need to replace 1 year of information with a new year of information. So you're still 1 year short of what you should be. Um, anyway, and then the budget, I think we already discussed the budgetary schedule issue. Okay. Oops, sorry. Just want to see if I want to mention anything here. Okay, I think we already covered budgetary comparison schedules sufficiently. These are some common errors for the statistical section. So again, amounts not agreeing to other amounts in the financial statements, outdated footnotes. So a lot of you have footnotes where we're supposed to be disclosing, things that you don't have to necessarily disclose every single year, new information, but anything that significantly impacted a trend, where there was a big spike or a big drop, you want to kind of footnote it and say, well, this was because of this reason. But that year maybe was 10 years ago or 15 years ago, so it's no longer applicable to the footnote. Similarly, before you would have in your financial schedules for the fund balance, you would have reserved, unreserved, and then you would have the new GASB 54, restricted, committed. And now all of the reserved and unreserved years, because it's been since, I think we implemented 54 in 2012. So you're not meant to have any reserved, unreserved, but you may still have that footnote that says, this was because of GASB 54. So you can delete that now. And then if you're new, like some of our clients, we have some clients that are new in, going with the ACFR. They recently just decided that they want to do a full ACFR. So you are permitted to accumulate 10 years of information as you go, if you don't have that information readily available. They do say if you don't have that information readily available, so don't necessarily just start putting, if you have the information, just put it. But you have to put a footnote saying that, this is the reason why you don't have 10 years of information. Revenue information of the most significant revenue source is not reported. So generally, you're going to put your property, for cities, generally you're going to put your property tax, sales tax. Those are usually your go-to most significant revenues. But we have a city in near Santa Barbara County, and their largest revenue is transient occupancy taxes. So where you have the town of Yountville, their largest revenue is transient occupancy tax, or a significant revenue. So it's inappropriate to disclose your property tax and sales tax when that only is your maybe third or fourth largest revenues, but then transit TOT revenue, you're just completely not mentioning it at all. Your debt information. So net bonded debt, the amount restricted for debt repayment shouldn't exceed the amount that on your financial statements. So you can't have on your financial statements that we have restricted for debt service for $100,000, but then when you're on this schedule, it shows restricted for debt service of $300,000. That's something that has to be consistent. Debt service ratio. So this is something which is a bit confusing. That's kind of a confusing area. You have capital outlay on your fund financial statements or in your governmental funds, but not 100% of that capital outlay may be capitalized. And also you may be capitalizing items that are not reported in capital outlay. You may have police vehicles you bought, but they're reported as police expenditures, for example. So you're really not meant to be using that capital outlay amount from your fund financial statements in this calculation. You're supposed to use from the reconciliation page that follows the statement of revenues, expenditures, and changes in fund balance that shows the amount that was actually capitalized from the expenditures. The schedule of direct and overlapping debt. So this may not always include 100% of your own debt, because you'll mention all of the shared debt where you have debt from the county, debt from other agencies, and then you would normally at the end have your own debt, your own bonds you've issued. You should also be looking at what else is not there that you should be including because you didn't mention it to the consultant or they didn't ask. like your lease liabilities, your speeder liabilities, other loans that you may have outstanding. Those need to be, either you could just tell them that I need to add this to my schedule. So when you send it to me, it has all the information, or you need to manually add it in there. I'm not sure when we're breaking for, when lunch is there. We get 5 minutes. All right, so just going to cover, how do we mitigate errors? Just because, it's not going to magically go away. Uh, so one piece of advice is just to have timelier closing. So I think with a lot of big projects, personal or for work, any big project or big task that you have, it's going to be easy to procrastinate on it and leave it till the end and then go into emergency mode and try to handle everything quickly. So you really want to break down that work into small pieces and plan it out. And a good way of doing that is to have a closing checklist. Okay. And so a lot of this information here kind of helps you with that, looking at your estimates, your accruals, communicating with any outside parties ahead of time to make sure you need that information, not when the auditor asks for it, that then you contact the third party to get that information. Come up with a checklist. So you can use your prior year closing entries to start a draft of your checklist. Our PBC list as the auditors is not your closing checklist. We only going to ask you for things that we care about, not necessarily every single thing that you need to be doing. So you need to know what you need to be doing and put that in a list so that you know that it gets done. Doesn't need to be overly detailed. I mean, we have one client, you ask them for their closing checklist, it's like just a spreadsheet with one column with lists of things they need to do. Involve others, include your accounting estimates, also include your financial statement draft and reporting processes, complete timeline for everything. You want to, in terms of preparing for the audit, make sure you request all items. They should be given to you timely. You want to make sure your closing is done by a certain date before the audit starts. You want to discuss with the auditors by reviewing that list if they don't know what the items they are asking for or when do they need things by. You can save system queries that they normally ask for as templates, so you can run those reports easily every year. Just want to see anything here. Yeah, and then throughout the year, if you have questions, feel free to communicate with us or your other auditors. We're a lot more happier to hear about these things before the audit starts than once the audit has already started and a lot more research is needed. Maybe we ask you for, well, you need this information, and it's like, well, this is going to take me another week because I need to go and ask it from another department, and they need to go to their warehouse to gather it. You want to just ask those questions as soon as they come up. Okay. Right. So preparation, you want to update your account and fund roll-ups quickly. The GFOA does have an example ACFR that you can refer to that's on their website. So they have a full ACFR with financial statements, note disclosures. So if you're not sure how to draft a disclosure, you can pull up their template ACFR and they'll have a sample footnote for that. Or you can ask your auditors. If you have new accounting pronouncements, standards, you want to see what's needed for that. What are the GFOA comments that need to be addressed? And then you want to make sure you have a detailed review process. So these are the things you should do if you have on your review process, especially focus on your unaudited sections like your stats and intro sections. These are some other helpful resources from the GFOA. I couldn't list them all. They have a ton of information, internal controls, and so forth. And I think we're out of time. We'll get you guys have lunch. But if you have any questions, feel free to email me or Ahmed, and we have to answer them.